Everybody talks about building a property portfolio, but how many people actually talk about their exit strategy? Building the right exit strategy into your portfolio from the beginning can be the difference of making hundreds of thousands of dollars, or if not millions of dollars, or even potentially reaching your goals faster, just by understanding this rarely spoken about concept. To unpack this in even more detail, I'm speaking with Director of Pure Property Investment, best-selling author and winners of Buyer's Agency of the Year in 2019, Paul Glossop. Paul's going to help us understand what an exit strategy actually is and give some tips of what everyone can take away to help better prepare for theirs, as well as knowing the difference of a good exit strategy or what no exit strategy can actually look like. I'm Jeremy Iannuzzelli. Let's get into this episode.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Welcome to What School Should Have Taught You. I'm really excited to bring in Paul Glossop today. Paul has known me from my very early days in the accounting space. He's actually seen me grow up as a professional, and I've been lucky enough to work with him and many of his clients over many years. You would have heard of Paul, maybe read his book, A Surfer's Guide to Property Investment, and also his buyer's agency and property advocate business called Pure Property Investment. But I've actually brought Paul on board in this show today, not to necessarily discuss buying of the properties, because where Paul and I have worked very closely with some mutual clients has not necessarily been the purchase of the property, but the actual exit of the property, because Paul's one of those property advocates that likes to work with clients on an ongoing strategic basis, not necessarily just buying the property and wham, bam, thank you, ma'am, but more so, continuing to buy properties for that particular person over many years, and also selling of properties as well, so that the person can continue on their journey and start to execute and strategize into many different things. So Paul, I'm going to welcome you to What School Should Have Taught You. It's been a long awaited time. How are we?
I'm very well, Jeremy, mate. Thank you for having me, buddy. And it does show our age, mate, because I was having a think about before we caught up or started this podcast today that I think it's been essentially the best part of 10 years since we've known each other, both from a professional and personal level, mate. And much has changed in life. I'm certainly got a fair few more grey hairs and a fair few less hairs in general. But mate, a lot of learnings have happened in the property space in general, and I certainly think that there's been some amazing results on probably both the clients we've worked on mutually, but also seen what you've done personally and professionally, mate. Has been a really interesting and amazing journey.
Mate, thank you very much. But today's a little bit of a different, I'm actually flipping what we normally would maybe talk about, which is buying properties and which areas to buy and what are you looking for and all those other things. But I think where I've worked with you really well and where I've actually seen some great client results has been the exit strategies. It's actually, you having that chat with clients and talking to them about, hey, this is maybe a time to exit this particular property because we're looking at moving your money into these particular areas. So I want to kind of get straight into it today and kind of ask you the question, and while it's a basic terminology, many people might not know what it actually means, but we often talk about the purchase and making money on the way in, but we very rarely talk about the exit. So, Paul, what is an exit strategy?
The reality of an exit strategy from the way we see it, there's typically a few different ways we classify it. And I think a lot of long-term investors who are buying for a hold might consider an exit strategy isn't necessarily just an actual physical sale. It might be, hey, look, once a property goes from a purchase price of, say, hypothetically $400,000, and all of a sudden they get a bank valuation of circa $800,000, then they might think it's a debt recycle or an equity redraw opportunity, which as you're building a portfolio, those opportunities should and do typically come your way if you're buying correctly, patient enough, and hold your property within the right markets at the right time. That's the tried and true strategy, and I guess what most people would be fully aware of. Now, I guess the challenge always comes, though, if you're looking to build and scale a property portfolio in general, there is always a limit of what you can borrow, and irrespective of what your income is or what your borrowing capacity is, everyone does have a limit on their borrowing capacity. And then an exit transitions from, hey, I've got this equity and I can redraw it and then buy again, to, hey, I've got a property that I might have bought well, it's got to a certain value, but I can't actually potentially leverage off that equity anymore. Or secondly, I might think that that market has done all the work that I expect it probably will do or can do for a period of time. So the choice is, am I happy to let that property just sit there in idle for 2 years, 5 years, in some cases in excess of 10 years, or is the choice to be more active and effectively sell that property, exit from that position, and then potentially either take that money into another asset or put it into a completely different investment class altogether.
And I suppose as people have become more sophisticated, and I've seen there's a lot more education, I've got What Schools Should Have Taught You, and there's a plethora of other educational material out there, and there's a lot more buyers agents in the market. I was just talking with a person earlier, and about 8% of nearly all transactions in Australia over the last financial year from July till June has been transacted with a buyers agent. So there is a huge amount more of material and more professionals that are out there, but very rarely does the exit strategy come into play. Now, you mentioned limitations of borrowing capacity, but you also mentioned something that was very important, which I tend to call it as a bit of lazy equity, profit that's sitting in a property that you can't touch. Do you want to just elaborate a little bit more on that so people get a bit of a conceptual understanding of what that actually looks like?
Absolutely, mate. I think, look, I'll give it probably a detailed example, and I think knowing that this was what we're going to be covering off in our conversation today, just probably drawing back on some examples that I've worked on recently within Pure Property with some clients who have been quite active investors, and not just acquiring a number of properties as an active investor, but knowing that there is going to be a time where their money's just not going to work as hard for them in a particular market. So it might be time to consider selling, taking it out and going into another market. When I look at that active and also that actual exiting of a position to then look at other markets, when you assess that a market's probably getting close to the top of where it probably is going to perform over the next short to medium term period of time, my mind's drawn to markets such as WA and Perth at the moment. That's a classic example. Even certain parts of SA and Southeast Queensland, I wouldn't necessarily discount the fact that each three of those markets in particular have had a sensational 5 years. The jury's out on whether the next 3, 4, 5 years is going to be anywhere close. I would suspect that it's not going to be anywhere near the level that it's been performing at. And we've got a client who I've worked with for the best part of 9 years now, who came to us back in, I think it was 2016, 2017, with an SMSF that was newly established at that time. Now, a really great example of how to be active and exit from positions, but use that money and not be lazy with where and what you can do is they bought their first investment through us back in Hobart, funnily enough, back in 2016. I think we ended up buying a property in Bridgewater, and it was two properties, one in Bridgewater, one in Gagebrook, very, very entry-level markets back then. And I think we paid sub 200 for both of those properties. They exited from both of those properties in 2021 for circa 450 apiece. The intention then was they had a obviously based on those numbers, they had a fantastic growth cycle that played out far quicker than what we would have otherwise assumed. I'm not going to proclaim that we expected to see 100% growth in sub 5 years, but it happened. And with that happening, the choice was, look, do we just let those properties sit there, be cash flow neutral, maybe pay them down, and be happy with those properties sitting there SMSF for another 26, 27, 28 years, because that's what they had between then and retirement. The decision was saying, hey, look, I want to get more active. So the decision was to sell both those properties, take that circa $400,000 in gross profit, pay about 50 grand in exits as far as tax and a range of other things. And then they recycled that money back in 2020 or mid-2021 into a property in North Brisbane. I think that was purchased at that time for about $470,000. And again, the decision was to buy that for a 10-year hold. That growth cycle happened a lot quicker than what they would otherwise expected. And they put a little bit of money into that and then a separate bit of money into a property in Perth. Now, I've actually just worked with that client. They still hold that property in North Brisbane in a suburb of Kalanga. That market's done very well. That property is probably worth now circa mid sevens to high sevens. But the property in Perth, which they also bought in a suburb of, I believe it was Armidale, again, an entry-level market. Back then, I think they paid circa 295-ish for that property. We sold that property, worked with them to advise to sell that property about 3 months ago. They sold for a touch under 600K. Wow. And they've now taken that money and they're soon to settle. And the strategy is to now consider taking that profit, which is going to be the best part of 300K in additional cash, plus the deposit they put into that, to probably consider some assets in Victoria. So I know I've sort of run through a whole bunch of cascading investments and active strategy there, but that's what I think, being more proactive instead of thinking I invest and I let it sit. And don't get me wrong, I'm not necessarily an advocate to suggest that everyone should be thinking, don't let a property sit there. If it's seeing good growth, it's time to sell down. An SMSF, and as you know better than most, mate, being an accountant and a property accountant by trade, is that it's an extremely good vehicle to minimise your capital gains tax. So it's obviously a very good vehicle to take profits and not be lazy with it. But that's an example of how over a sub 10-year period, you can take an initial cash injection of about 150, 160 grand. If they sold everything now, they'd be looking at about $1 million cash that has come from that. So, you're talking close to probably an 8 or 9x return,
which is a fantastic result. Absolutely fantastic. And it's good that you've used, and again, we haven't spoke about this prior to it, so it's great that you've used an example around a super fund, because for many investors that are listening, many people that are listening, a super fund, you can't extract any equity. So when properties do increase, it is very lazy, unfortunately, and the exit costs, as Paul mentioned, are relatively lower in super because of the tax. Not necessarily lower, agent's not going to charge you less money to sell the property because it's in super, but your tax being about 10% at effective rate over the entire gross capital gain. It's a brilliant entity to accumulate wealth, even when you start to think of this nasty unrealised Division 296 tax they're bringing in. But I always say it's a good problem for many people. If you can start to touch the realms of having a $3 million super fund balance, you've done some pretty good things. But I think that's a really good example of a well-executed strategy. I know hindsight, looking back, getting out of Hobart when you did for that particular client was unbelievable, because we know the market there has retracted back a little bit over the last couple of years, and then obviously WA, it's gone through that really big boom, and you've decided to keep still the North Brizzy property because you've got other factors in there regarding Olympics and other things. So with hindsight, great decisions. But then I suppose it comes to the next one is, importance of timing the exit. And more importantly, how often have you seen, and this is now you as a professional, how often have you seen someone actually get the timing perfect? So firstly, I'm going to start with that. How often, Paul, have you seen someone time their exit perfectly?
But I'll say this. I'd say if I listen to this podcast or watch this podcast, however I want to consume this podcast in 10 years, I will probably look back and say it was all wrong. Should never have sold, because hindsight in properties never told me that the market's gone backwards for an infinite period of time. So for me, it probably comes down to a real simple consideration to say, is the utility of this equity or money going to give me a better opportunity in another market or another investment class? And if the answer is yes, then the timing, as far as is it this month, is it next year, is it in 5 years, becomes a bit irrelevant. If I'm looking at specifically trying to time it, there's obviously things like financial years and tax considerations, which I think people do get wrong a lot of the time when they don't actually think, oh, hang on. And I literally, before our podcast now, mate, I was just on the phone to a client who's just finished a development in Sydney, and they sold one and have settled this financial year, and obviously next week, as we're recording, is going to be the next financial year, and they've intentionally now spread that across those. I think they've got some good advice from their accountant, but without that, they would have just flogged them both and taken their money and run, and probably paid some significant more amount of tax unnecessarily. But if I look at the timing, for me, it always comes back down to, is the utility of what I can do with this money going to work harder for me in the next 5 years elsewhere? And if the answer is yes, then the price you get on the day, or whatever someone's prepared to pay you, if that money can work harder for you elsewhere, then that's when I always suggest the timing is correct. It's not necessarily saying, did you wait for another 10% growth to come, or did you time it right at the peak before it started to go on the back end of a growth cycle? And
I think that's imperative to understand. You've got to factor in multiple different things, tax and not just selling things to buy cars, or it could be selling things to to go chase other opportunities. Or, I've seen some really some really good clients of mine, young guys within 8 years, sold 2 properties and then paid down their principal place of residency debt, freed themselves of that, those ball and handcuffed and chains, and able to debt recycle. I know you mentioned that very early on when we're chatting, debt recycle. And now they've got a couple of other properties in more well-structured finance. So there's a lot of things there to consider. Now, I want to just touch base on a couple things around costs. Now, this always comes into play with my clients, and I'm always having chats with them. Jeremy, I've got an old home. It needs a new roof, new gutters, the stumping needs to be done. What are you typically advising clients? You may have seen the property grow in value, or it may have not moved, but it needs all this work, which I wouldn't deem it as cosmetic upgrades. Those are things that are definitely happening for many investors who be listening to this now. They're probably relating to it. I've got a 40-year-old home that needs all this work. What's your advice, or what's your take as an investor in a property specialist? What would your advice be to someone like that who's considering whether I keep it, sell it, or go spend all this money where I may not get the necessary value uplift just yet?
These are the tough ones as property investors, because you're sinking money into something that is not adding value to a property. And I can draw on an example of my own, mate. I've got a property that I own, a duplex both sides down in the Wollongong region of Sydney, which I've owned for well over a decade now, and it's probably tripled in value since I first bought it. Great yield, great block of land, zonings. Essentially, I could do a lot more with it now, etc. And it's exactly as you painted, mate. It's probably about 40, 45 years old, and it is a struggle. It definitely deserves a lot of my time, effort, and money, and I do get frustrated with it from time to time. And I've just recently got an email from my property manager saying that there is a mold issue, which isn't the first time I've had this mold issue. And as a responsible landlord, you do have to make sure these things are addressed. Now, painting over it and trying to tell them to open up some windows and get some cross ventilation, it's a band-aid solution. There's obviously a reason why mold has come to the property, and I've had to now engage a specialist to then figure out where and what is happening for this rising damp. And as it's turned out, we've got a leak in the roof, and there's also the cavity wall that divides the 2 properties is not sufficient. So solution is I'm going to spend probably somewhere between $10,000 and $15,000 to reseal the roof, and then also to put a sump system in to essentially collect moisture so we don't get this rising damp issue. The reason why I highlight this is that I am going to spend this 10, 15 grand to essentially just go and put this money into this property that will not increase the value, will only decrease my bank account, and won't increase the rent either, there is tenants in place, and it is my obligation as a landlord. B, the reality is I have no need, or I have no desire to sell this property on any time in the short to medium term. So I don't want to think, hey, is this market past its prime, or could I use that money elsewhere? The property is yielding me, based on purchase price, probably circa 20% now. So I see it as something that will stay in my portfolio forever. So I think when I look at those scenarios of that type of property, I sort of assess to say, is this a property that I have no intention of vacating? Is this money going to then put this property back into a position where I can forget about those major structural issues or any other issues which I think are going to inhibit me getting a tenant in there for the next 5-10 years? And if they are answers that I can clearly say yes to, then for me, the money's going to be invested. Now, 10, 15 grand isn't going to be a bank breaking amount of money for most. However, it is a significant amount of money. And most people can't just go and find that money unless you have to keep that spare as part of a war chest or a contingency. So there is always those things that come into the fold when you're considering building a property portfolio. You've got a large number of properties. Every property at some stage is likely to have something similar to this issue that I'm pointing out right now. And I think that's probably the key part here, is that I'm always happy to invest in property if I know it's part of a long-term hold. But B, and probably more importantly, it's prudent to make sure that I have the cash or I've released equity previously to make sure that I've got that money sitting there with the intention that I know it's going to be invested in these things. So you mentioned earlier, not spending this money on stuff that is not going to be part of my wealth creation plan long term. This money doesn't get touched. I have ring-fenced amount of cash that has to be applied to a percentage of my entire portfolio, and it's for these reasons. And I think anyone who's considering setting up a larger property portfolio needs to have this in mind. Money are there available, expecting that they will get these calls or these messages, and don't be too disheartened because the property will repay you in time. And to a degree, there is some tax deductions that come from it as well.
Absolutely. And I think that's good. You mentioned about ring fencing a certain amount of capital. And I think that's what a lot of people need to take from just those couple of comments. You've got to have that buffer in place. If you don't, then you're going to be forced to sell as opposed to wanting to sell. I want to just talk about sentiment, what drive of markets. And, people often say that, when do you know it's a seller's market? How do we know it's a seller's market? What indicators? Is it price? Is it just 50 people turn up to open homes? Are they correlated? Because sometimes prices could be high, but no one turns up. What are you looking for if you are looking to exit a property or having a chat with clients about exiting a property and no one's going to get the timing right, as we know? Is it price, which is what you're looking for? Is it number of people turning them up to open homes? Is it sentiment, interest rates? What are some indicators for you to say that we're probably in a seller's market, maybe not so much a buyer's market anymore?
Yeah, I think that, and Australia's, I would deem it to be in a normal market cycle right now, and it's a bit sort of on the nose to say that, because the reason why I suggest Australia's in a normal market is that if I looked at 5-6 major capital cities right now, they're all at different stages of a cycle, and we've gone through a very, very interesting 5 years, the most interesting 5 years that I've seen as a property investor, and probably yourself too, mate, where we probably saw 2020, 2021, and realistically 2022, where if you had property and you wanted to sell it, you would sell it. And if you priced it somewhat correctly, it's going to go. Now, from 2022 onwards, and more or less since we start to see the RBA rate hiking cycle, that we saw that divergence happen almost overnight, where Brisbane, Adelaide and Perth all kicked into gear even more so. Sydney, certainly Melbourne, Hobart, Canberra and Darwin's been sort of a bit indifferent and average for a good decade, but all these markets started to split out. So we went from certain markets, or all markets going through to be a seller's market, to essentially some markets being balanced, some markets being a complete seller's market, other markets being a complete buyer's market. But if I was a sort of a novice looking to figure out what are the indicators that I'm considering to figure out if it's a seller's market right now, and deeming that to be, hey, if you want to get top dollar and sold property at a quick rate without too much fuss, and making sure that you're going to get a price that's going to be the correct price, and not having to pull your pants down, so to speak, to just get the property sold at all cost, there is going to be some really clear factors for me that are pretty obvious ones. And you don't need to have a very expensive, sophisticated data purchase to figure this stuff out. If you subscribe to realestate.com or even domain.com and you go into a particular area and you go through a list view of a particular suburb and look for properties that are sold, if you can start to see under offer sitting at your top 3, 4, 5, 6 properties, you'll be able to see very quickly that you ultimately can see that there is a lot of properties that's listed, but then essentially is not available, that might be under contract. The other things which you can get your hands on pretty quickly and typically quite free, I know SQM is a great free resource for anyone who wants to look at some data there, is you look at average days on market, and trend lines on average days on market will typically give you a very good understanding, and not just the general sale of residential property, but you can split it out to houses, be it 4-bedroom, 3-bedroom, apartments, be it 2-bedroom, 3-bedroom, and so on. You can actually see the split out of days on market. And obviously there's a correlation between the shorter the days on market, the higher the demand for property in those particular areas. And if you start to look at a window of 3 years, 5 years, and you start to see trend lines of days on market go from, say, circa 40 or 50 days down to sub 10 days, then it can pretty much unequivocally tell you that there is a huge amount of demand coming into that market, which ultimately means that if you want to sell a property, if you price it somewhat correctly, then it will sell. And I can speak to a market that's a good example right now, that Perth, although it's had a fantastic increase in value over the last 4 or 5 years, the last 10 years, different story. It's still probably on an average cadence if you look at it over the last 30 or 40 years worth of data. But you can still sell a property in Perth within a week right now without trying very hard at all. And we've worked with a few clients literally in the last week to sell property off market to agents through their database with no money to be spent, selling it at what we deem to be about market rates. So if you're pricing properties correctly in seller's market, that's the outcome you should achieve. But then you compare that to other markets which are probably going the opposite way, going from 10, 15 days on market up towards that 30, 40, 50 days over a 3-5 year trend line, that's when you start to become concerned, because there is going to be an issue if you do need to liquidate that money or liquidate any of that cash and or equity that sits within there. And that's when you start to have to think, is this the right time to even consider selling? Do I need to sell, or am I in a position where I can sacrifice other things to hold this property because the timing might not be correct or right there at the moment?
Yeah, and I just would love to get your opinion, especially, again, you work with many people and you're a bit more of a concierge type of service that's provided, but what are the reasons why, you've worked with some people to sell out of some areas? Are they doing it for debt reduction? Is there other opportunities they're moving it into? They hit borrowing capacity limits. What are some of the reasons as to why your clients are selling in certain areas, and what are they doing with the money thereafter?
I'm very reluctant to ever recommend anyone just sell for the sake of taking cash, and particularly cash at this stage in an interest rate cycle is going to be not a great place for it, because if you've got inflation coming down, you've got cash rates coming down, having money in the bank's really going to serve you very little unless you are preserving that money for a bigger investment that you have your eye on. I think for us, if we're looking at people to exit a position, i.e. sell and take a profit out of a property, the intention is probably 8-9 times out of 10 to try and get something that's going to give them a better outcome over the next 3 years, 5 years, and 7 years. So that's typically the vast majority of the rationale. If someone's hit a borrowing capacity predominantly, that would be the first trigger, because if you've got equity and you haven't hit your borrowing capacity and you can access that equity to then take it into another asset, that is typically going to be our default or our preference. But sometimes there is also considerations like land tax thresholds, even things like too much exposure. If you've got 2, 3, 4, 5, 6 properties in a particular market, you might look at saying, hey, look, I'm happy to maybe keep 1 or 2 there, but I want to exit my position on those others over the next 12 months, 24 months, take some of that profit, take some of my exposure away from there and recycle it, or put it into an area where I might not have exposure, might not have the same considerations around land tax, might also have properties in those areas, which, to my example earlier, maybe those 40, 50, 60-year-old properties, which may not be costing me an arm and a leg right now, but I know that there's probably only another couple of years before they're going to be significant cost impacts on those properties. So you start to have to be a bit more pragmatic and have a bit of foresight to think they're probably not the properties I might want to hold long term, plus there's profit in them. So is it time to take that profit, crystallize the cash, and then put it into something that might be a bit more streamlined?
Beautiful. And it's funny that you mentioned land tax, because I'm having a lot of conversations with clients who have held properties, especially here in New South Wales, for a very long period of time. And I'm going to be not letting the cat out of the bag, but some New South Wales state government have done something very underneath the radar. It hasn't received any airtime. Media hasn't really picked it up. But land tax for New South Wales residents, if you are over the threshold, it's going to become a lot more expensive as time goes on. And that becomes a major issue in being able to hold these properties longer term, depending on where you are, obviously, in your journey or in your life, and from financial circumstances point of view. Now, Paul, I want to ask one more question, because this is probably one of the biggest questions I get. Many people are either at the start, in the middle, or even some people at the end of their property investment journey. As we age, is residential property again, it's an opinion and everyone has a very different opinion, but as we age, is residential property a good income generating retirement asset? And is that maybe a time for many people to think about exits, or if it's something that comes earlier? But what's your thoughts and opinions of residential property as a retirement asset?
To answer it really simply, mate, I think the unequivocal answer is no, it's rubbish. If I look at it from a yielding or an income standpoint, I don't care how good your gross yield is in resi property. I mean, I've got plenty of it, so do you, mate, and I look at it and say, look, it keeps me in the game. And that's the intention of resi property income for me. For the most part, residential property is there as far as an income's concerned. It's there to see growth. It's ideally holding land that's going to appreciate in value over time, and the cash or the income from it, regardless of whether I hold no debt or have the same debt as the purchase price that I have, or I've topped it up and taken equity out over and over, the yield never seems to be something significant enough for me to think, great, I've got that property that's giving me a great income. I think it's always been and always will be enough income, particularly in Australia, because in other markets overseas, residential property, there are certain markets which can give you a far better cash return. So I don't speak about this generally globally, but I do look at in Australia that for me, it's a growth play initially. There are certain ways, and I don't see potentially the need to sell out of all of your resi property as a retirement strategy. But I think if I'm getting to the point of saying, hey, I don't have a steady income stream from my vocation anymore, I'm planning for that to switch off, whether it's coinciding with retirement, whether I'm selling a business, or whether I'm just quitting my job. Residential property should be there, I personally believe, but it needs to coincide with whether it's a commercial net returning asset, or even if it's going to be a higher dividend, predictable ETF in the share market, or even cash with potentially a fixed return on it in a bond situation. There's a range of other things that I would like to see it diversified into. So to answer the question, mate, I don't see it as a tremendous income generating asset. It's a tremendous wealth creating asset in the sense we see that growth well beyond most other asset classes when we consider the compounding return over time. But from an income standpoint, I'm personally never going to be relying on residential property to give me that income. There is going to have to be an exit at some stage as a portion of that portfolio to give me that residual income, or give our clients a residual income to actually go and enjoy whatever they want to be doing in their spare time.
Mate, it's well said. And I just want to ask one more question, I suppose, just because, again, it's not something that's very commonly spoken about. A lot of people will do property plans, and it's a property acquisition plan. But are you also doing along the lines and along the way of that property acquisition plan and injecting in there maybe some exit planning as well along the way, and then a repurchase plan? Or is it just a straight arrow up and then it's a straight arrow down? Do you want to maybe give some context around that?
Yeah, I look at it as it's probably more that sawtooth scenario where there's always, without acquisition, there's never going to be the choice of what do we sell down. So there's obviously going to have to be a lot more focus in the upfront to say, how do we get our portfolio to a certain level that's then going to give us choice to say, do we sell down? Do we reinvest in income assets? Do we sell down? Do we reinvest in more growth assets? Or a range of other things that might come from those decisions. So what we typically do is upfront, majority of the focus, particularly if it's a client who has a principal place of residence and a bit of equity and looking for their first investment, or even potentially a client who has 2, 3, 4 investments, but knows that, hey, I need to get my portfolio to say circa 2.5 to 4.5 million as a baseline before I start to think I've got enough exposure. Then I've got to let that do its work in the market. That first focus is let's get this vehicle exposed to as much growth assets as we possibly can. Once we get there, and once we also then start to encroach borrowing capacity limits, and also maxing out where our cash flows can hold these properties comfortably, taking into consideration buffers, etc., that's when we start to think, okay, is it time to then consider transitioning, transacting? And part of our process is setting the plan up initially to look at these acquisitions, but intentionally, typically annually, we'll proactively reach out to every single one of our clients. I sit down and go through, where are we? What's the next step? Is it more acquisition? Is it do nothing? Is it to switch our structures of our loans from P&I to interest only, or vice versa? Is it to consider selling down that asset to repay there? Does SMSF start to come into the conversation? Do commercial assets start to come into the fold? And a range of other things into those meetings as well. And a lot of the time out of those meetings, there is then follow-up meetings with the indication is saying we need to speak to your accountant, you need to speak to your broker, even financial advisors, etc., because that's when it's more of a holistic conversation as well. I don't like to make those decisions in isolation, because there is a lot more than just, hey, is it time to sell? If so, yeah, the market's done a great deal of work for you, then let's just sell without considering all the outcomes from that.
Yeah, beautiful. So again, people that are listening, it's not just a beautiful road up and a straight way down. There is planning involved in it, and as Paul mentioned, very much a bit of a sawtooth type of strategy. You've got to first acquire, then you can start to change and pivot, and then from there you can continue to move upwards or go downwards. It depends on what you want to do and where you are in your strategy, whether you're debt reducing or debt increasing. It's completely up to you. But in summary, I think, a couple of great things that we've learned is that, exit strategies are important. It's not just one-sided. That property investment is not all about buying. Sometimes you also got to look to pivot. Whether you can, as Paul mentioned very earlier, ring fence a certain amount of capital to make sure that you've got buffers, because you want to sell as opposed to need to sell. At the same time, you also need to consider that the amount of money that you're thrown into a property, is there longevity to get that level of return back from growth in the future? Because not necessarily is all the money you're going to spend on your property new kitchens and bathrooms, as Paul's doing. I think he mentioned he's getting new roof and also a sump there to stop some mold and rising damp issues as well. Markets, there are certain structures that you can utilise. As Paul mentioned, a client of his with Super really did well in Tasmania and then moved to northern parts of Brizzy and also WA. And it's a great way that he's reducing his exit costs through the reduction of tax based on the structure they're using, but utilising a lot of that lazy equity that's there, because we can't extract the money out in Super. So sometimes transacting, utilising the profit and then being able to buy more properties or better quality properties are important. And then most importantly, one thing that Paul raised as well, and I think it's fundamental, is discussing and having those constant replays of meetings with all the professionals around you about where you are, where you need to be. And obviously, the last thing you mentioned around property side of things, if you are heading towards retirement, you've got to make sure you've got the right assets, achieving the right results for you, because not necessarily where you've got money movements or capital growth on paper, it's not necessarily going to pay for all the bills, especially when it needs to come out of your bank account. So it's just factoring in having a very holistic approach and a very much bird's eye view of your overall financial situation, and knowing what levers you can pull at any particular time to have a consistency and a movement forwards as opposed to a period of stagnation. Because Paul, you've been investing for a long time, and as investors, there's nothing worse than being in a market that's stagnating and everyone around you, there's things that are growing. You definitely get that fear of missing out, don't you?
Mate, absolutely. And I think there is a big definitive difference between those who have done really well in property and those who have done okay, or those who have done next to nothing, is the ones who are prepared to consistently ask questions and stay active. And it doesn't mean that you need to be on a high 6-figure or 7-figure income to be able to continue to invest. I mean, I've got some of the most successful investors that I work with are on normal incomes, potentially combined incomes, household incomes of circa $180,000 to $250,000 a year. I'm not suggesting that's a small amount of money, but it's relatively average for a property investment couple. And usually what they have in common is that they catch up with me very regularly. They catch up with their broker very regularly, their accountant very regularly, and they're the ones who are pushing the envelope. They're not happy to accept status quo. And once they get the tap on the shoulder, say, you're maxed out. The question is, okay, well, how do we become non-maxed out? Are there second tier, third tier, private money lenders? Is that too expensive? If so, okay, are these the best assets that we should be holding? Okay, well, if not, then let's sell. And they usually make decisions after collecting that information. They make decisions relatively swiftly with the knowledge at hand, but they don't procrastinate. And you've got to keep being active. If you want to be someone who's going to enjoy the fruits of a property portfolio in a 10, 15, 20, 30-year time horizon, you're not going to get there by 1, 2, or even 3 properties, unfortunately. So you need to keep being active and keep being curious.
Couldn't agree more. Active investors are the ones that are getting the results, and active investors, there's a bit of time that you need to put into what you do every day. And if you sit on an armchair, or be otherwise known as an armchair investor, you will get armchair results. More time, more effort, and more education you put in to your overall journey, you'll generally get the fruits of your labour. Paul, thank you very much for your time today. It's been fantastic for you to share, I suppose, the other side of the property space and the property specialist space. It's not always sometimes about just that rocket upwards of buying properties, but it's also being very strategic with when you're buying and potentially when you're exiting. There's a lot of things to factor in, the property's age, or where you're sitting in terms of your financial goals, or even where the market's moving, or potentially what even entity you're in. So there's a plymouth of factors that are there that you need to understand, and it's very important that you do consult with all the various different professionals around you to ensure that what you're doing is working to a far greater outcome, because there's nothing worse than spoiling all that hard work and potentially just putting money into other assets. Could be even bank savings in the bank, which is not doing much. But if you want to reach out to Paul, you can definitely reach out to him via his website, purepropertyinvestment.com. Also runs a very great podcast as well, Pure Property Investment Podcast. And his book's still out there. It's been there for quite a while, Surfer's Guide to Property Investment, which is found in all major retailers in Australia. Paul, I would like to thank you once again, mate, for joining us today. It's been a very long time. I know you've seen me grow up in this space, in this industry for a number of years, but it's exciting to have you on today, and it's also exciting to talk about some real exit strategies that you've done with many of your clients.
Legend. Thank you, mate. Appreciate it. And thank you for your time. And hopefully there's a fair bit of information out there that I think the listeners will get some good insights on.
Brilliant, mate. Thank you and all the best.
Thanks, mate.